Hello everyone, welcome back to Chill Deal Trades, where I analyze the market so you know what's going on. Today we're going to be covering Chinese stocks. There's obviously been a lot of drama lately, and I'm kind of going to break down why I think we're in the fourth quarter, which might be the most dramatic period, but also keep an eye on things because it might be a good investment opportunity coming up soon. If you're here and you haven't hit the sub button, please hit that and join the squad. We're on the road to 500 subs, so please help us get there. And we've started a Discord community, so check that out and join there for everything we talk about, finding stocks to invest in. But let's get into things. So I want to talk about Chinese stocks because I've had some videos on Alibaba on the channel. You can go watch those. But I really wanted to cover the market for Chinese stocks in the US holistically, mostly because we've seen them move in tangent lately. So when something happens, all the stocks move, and that's important for when I make Alibaba videos, or if there's other companies that you're interested in, because they're going to move together. And so the first thing I want to bring up is there's been a lot of news, specifically on CNBC lately, about do not buy Chinese stocks. Jim Cramer today came out and said you can't own these stocks. So this is why I think we're kind of getting to the fourth quarter of the action. If you watch sports, the fourth quarter is often the most dramatic period and can have the most swings or a fight back and forth, between two teams. But in the market, it might be the Bulls and the Bears. And so I really think there's going to be this kind of last period is going to be extremely dramatic. And we need to keep an eye on to see if there's potential opportunities to buy sometime in the second half of the year. So kind of getting off just this news about Jim Cramer saying don't own, I really want to look at the Chinese economy holistically. And so one thing that we need to know is that Chinese debt has been significantly increasing over the last few years, but especially this year, kind of similar to the US. So when we kind of look at this chart, this is China, Japan, US, and other areas. The yellow line is China, and we see a really big increase in their debt to GDP ratio. And why this is important is because when we go to this next chart, GDP for China over the last basically from the 70s, the 60s, all the way to 2007, were growing in between 20 and 10% year over year, on average for the year. When you compare it to the US grows at maybe 1 to 4% depending on the year, and so China has dramatically closed the gap on US as like the largest or superpower of the world. But what we're starting to see is a decline in growth. And this is even pre-COVID. And this is important because China has essentially used debt to grow their country, especially their GDP. If you think about them, they became a source for labor in the first, where U.S. was basically a lot of saying their product, or companies were having their products made in China sent back to the U.S. And that's how the economy started. And then China got into the tech industry because they started taking IP from other countries, coming there for their cheap labor. And now China's in the stage where they're creating their own technologies, and they're no longer just copying what people do, but they're starting to establish their own economy. And so as an economy grows, the growth rate has to slow, but we really need to pay attention to if this debt continues to increase compared to their GDP growth slowing. And a reason I bring that up is where institutional money is flowing, or I would say investments are flowing. So what we see here is, for the first half of COVID, US investments were going down drastically, but November, we see a crossover where a lot of fund flows started going from the US and not as much in China. And this is really significant because China stuff has been struggling, but we're seeing a lot of money shift to the US. So as China's GDP slows down, as their debt increases, and they have less money flowing in, they need to make changes in order to support their government. And so that's a part of the reason why I think a lot of things are happening right now. I think partially, as we know, the Chinese Communist Party, they obviously want a lot of control over their nation. And so with tech companies and things coming up, they really want to control what's happening. But the second thing is they need to figure out how to successfully grow their financial sector or their financial system in order to bring money in. And so I think that's what we're seeing on one part. One part, we're seeing the Chinese government wants more control. And the second part is they need to set up a legit financial system so they can see more money flowing into their system. to help growth because, well, as we've seen, debt has increased, GDP growth has declined, and so your country can't continue to grow unless you have international funds coming in to support your economy. And so I think that's why a lot of things are going on in terms of decision making. But we're in the fourth quarter, more drama could come, and so we just want to keep an eye on things. And again, I'm super bullish long term on China, but I think they're going through some growing pains right now. Next thing I want to bring up is just what's been going on. Like, why have Chinese stocks sold off so much? And so there's just so much drama going on. That's the best way I can put it. If you don't know this, China and US are basically at this point fighting to be the world superpower. And, China released a digital currency. US is doing that. The US has a really amazing financial system. The Chinese government is trying to create one. They're trying to bring flows into their country. So it's really this tug of war. And so a couple things we want to look at this as an update of what's happened. So last year, Congress passed that all foreign companies listing have to have their audits inspection in the next 3 years, or they can be delisted. So that's a really big thing. And for a stock that we love, Alibaba, this is something that they've experienced. Sorry, voice crack. But that's a really big deal. So we'll have to see, what actually happens with this and materializes, because we don't know yet. But that's, I would say, the most overarching looming negative is we have to see what companies or what China does in response to the U.S. saying that. And that's why we've seen some of things of, China saying, we're not going to let companies list on the U.S. market. Right here it says Chinese government has launched its own assault. Chinese government blocked users from downloading the DDX. So they're making their own push to counteract what the U.S. is trying to do and forcing these companies to show their financials. And as we've seen in the past, China really wants a control over the technology getting out. They don't want other countries to see the technology they're working on. They don't want to see how their companies are doing. And so they're trying to find ways to fight back. And so another really interesting point I found out, this is a little speculative, but it's very interesting. So if China brings that DD shares, that it's a scenario where China could try to drive the price down so they can take the company private. And so he gave an example here. This company, they said the Chinese company IPO'd, and then what later happened was the price came down, and then private investors ended up buying the majority stake and taking the company private. So this is something we've seen in the past. And so with DD going public, these are scenarios that could be playing out. But a thing to remember is this kind of scenario is not going to happen for the big companies like Alibaba. And so when I'm looking at Chinese companies to invest in, I'm looking at to stay towards the Alibabas, the Baidus. I don't really want to invest in these high growth, early stage Chinese tech names, because I think they have the highest risk on the market. To bring up a couple other points more recently, what's been going on. So we saw that the other day, China, I think it was today or yesterday, China said that their online education platforms have to potentially become nonprofits, so they're not going to let them take in outside funding. And I think that's, again, part of the CCP trying to gain some control over the companies and what they're doing and their decision making. The announcement added that investors fear about regulation overreaching from Beijing. So again, like I said, CCP wants control, people are getting scared, and that's causing to a sell-off. And as we mentioned last one, the U.S. government has threatened to delist a number of Chinese stocks. This is something ongoing, and that's why I'm personally looking at the more safe names. Again, the Alibabas, the Baidus. These are companies that are going to have the lowest chance of being delisted and or the lowest volatility in their names compared to today. We saw the educational platforms move like 50% to the downside. That's something that's probably not going to happen with Alibaba. But this article, I'll post these articles because there's a lot to cover, but I'll post them in the description so you can read through them. There's a lot of good information here, but we've kind of covered the majority of the news going on. Something really interesting that I want to bring up, and this was an article from the 16th. It says that record cash floods China's tech ETF. So when we look at this chart, what we're seeing in July is as this thing is sold off, and someone just lost a lot of money because it drastically moved down today, but we're seeing record inflows. So as I say, this is the fourth quarter. A lot happens in the fourth quarter. The most points are scored in the fourth quarter a lot of times, or the most back and forth goes in the fourth quarter. And what we're seeing is we're starting to see money inflow. And so moving forward in the second half of the year, we're going to want to keep an eye on if money keeps flowing into China's major ETFs. So this is KWEB, which is the tech one. We want to see if that money continues to flow in. And if it does continue to flow in, then we might be seeing opportunities to buy in for the long term. So lastly, I actually want to go over some charts. So the first one I'll look over is the MCHI, which is, I would say, a more general Chinese ETF. It's not just tech companies, but the top holdings are kind of Alibaba and Baidu and things like that. But I want to look on the weekly chart. And so the first thing to bring up here is MACD has gone under 0, which is a pretty big deal. We haven't been under 0 since the COVID crash, and we're just hitting that point. And we're seeing a pretty big downturn. Let me zoom in a little bit here so you can see it better. We're seeing a pretty big downturn in acceleration. When you see these lines start to go down drastically, that typically has a lot of negative momentum. So that's something we really want to keep an eye on. When we go on the weekly, we still have a lot of opportunity to come down. So as I always say, when something's hovering under 50, it's typically negative momentum. And we're still quite a bit ways from oversold. And so generally speaking for Chinese stocks, I don't think a bottom could be in yet, even though we've had a lot of selling. And so as for more recent, something really important on the weekly charts we want to see with MCHI is holding the 200-day. So on the weekly chart right now, we are testing the 200-day. That's really, really important. If we can't hold that, then when I looked at the chart, I actually found a gap it's at $68. And so if we can't hold this, super important, we could be headed down to this gap fill range, which is at, what did I say, 68. So a few more dollars of downside. This is a range that I'm going to start. If we do head lower in this range, which is a important support, especially if we head past this consolidation, if we blow through it, then around that $66 to $68 is a range I'm really going to be considering to buy into some of the names like Alibaba, Baidu. I don't really want to own the funds personally. I want to know the stocks I'm owning in China and the ones I believe in and have conviction in. But this is something you want to keep an eye on, is if we hold this 200-day. If we can't hold that 200-day, that's really negative. We could definitely come into this, we're at 74 now, so this 66 to 74 range over the coming months. The next one I'll look at is KWEB, so this is just tech companies, and this is on the daily chart first. So what we're seeing is we're seeing a lot of negative downward price action in the EMAs. So when we see such a downward price or downward slope, that's extreme negative momentum. So as we can see on the upside, pretty high, and what they do, they rose pretty significantly. But now we're seeing very drastic downwards action. So until we see these start to slow out a little bit and kind of hover more like this angle, we're probably going to continue to have dramatic downside. Probably not something like today, 8% for this, basically, which is an ETF, or is an ETF. Probably not that, but we could continue to go lower. So some of the prices I want to look at, I actually want to go on the weekly time frame. So the first thing I want to bring up is we actually broke below the 200-day on the weekly chart today. So we're going to want to see if price, let me zoom in here a little bit more for everybody. I realize that I'm not zooming in enough on my charts when I do videos, but we want to see if it comes back up and tries to test that 200-day. And so something really important is, so I drew a trend line back when this IPO'd back in 2014, and we have a trend line right here that's basically at the 200-day. It's just below it. So we broke below that long-term downtrend or uptrend, which is very negative. So we're going to see if we can test that trend line or test 200-day. If we stay below it, I would say we still have negative momentum in the short term, and it's something we want to keep an eye on. When we look on the monthly, we also see that the 50-day and the 100-day are starting to move, are turning. So if they continue to turn, just like we looked on the daily, as they accelerate more to the turn more to the downside, that's a really big negative. We definitely could get a rebound off this 8%. That's pretty drastic. But I'm going to be looking in this 53 to 61 if we can stay in that. But if we break down, we could definitely move towards 47. So 47 to 63 is a range I'm going to be looking at over the next couple months to potentially find a bottom in some of these Chinese names that I believe in. But that's a long video. That's all I have for you guys. Thank you for watching the whole thing. If you did, I'll be doing an Alibaba video tomorrow, so go check that out as well. But I appreciate you stopping by, and I make a video every day, so I'll be back tomorrow.